fundamentals on how to build a real estate portfolio starting from property number one. One of the things I'll be talking about a lot today is it's very important to plan properly and how you structure things right from property number one all the way up to, if your plan is to buy 5 or 10 plus properties, it's really important to build it properly and right from the beginning, make sure that you have the right plan. So I will do a little bit of a highlight on the first 5. I'll be talking about planning. I'll talk about the key core professionals that are really important for this phase of your investing career. When you're getting into the 5+ category, there's a few things that become more important and more heightened. I'll be talking about the big question to incorporate or not. Very common question that I get asked, every accountant get asked, and it is something that is very difficult to answer. Not easy to give everybody a blanket response, but I do have some slides I'd like to go over for that. Also talk about setting up your personal finances in the way that will best allow you to qualify for those mortgages that you're seeking. Also talk about how lenders qualify rental properties, the 4 most common challenges for 5+ investors, and of course a few solutions in order to be able to do that. And then I'll wrap it up by talking about a few upcoming webinars and a bit of a Q&A at the end. Also, just a quick heads up. For those of you that have missed any previous webinars, they are available on our website. So you can go to our website at www.greenmortgageteam.ca. And this one is being recorded as well. And we'll send out the recording to all of the attendees or anybody that has registered for this. So if your friend or family member has registered but can't attend tonight, we'll be sending them a copy if they registered for this. So looking forward to getting started. All right, let's talk a little bit about where we left things off. So I did show this slide last month, and we focused last time on really building up your first 5. So your residence, buying your first rental property, and then getting up to 5 rental properties. And we never really got into the 5+ category. So let's just go over a bit of a highlight of what that looked like. And here's a quick summary of buying your first 5 properties. Number 1 is planning. So I like to say this, and I did not make this up. Somebody else much smarter than I crafted this saying. But if you fail to plan, you plan to fail. So it's really important, especially with building a real estate portfolio. I cannot tell you the number of times that we have clients that come in when they have 3, 4, 5 rental properties, and we look at things and we say, you know what, we're going to have to redo a few things in order to take you the next step. And sometimes it's actually taking 1 step backwards in order to take 2 steps forward. Or sometimes even 2 steps forward to take 1 step forward, or 2 steps backward in order to take 1 step forward and then another step and another step. Getting a HELOC on your residence is a very important key as well. Owning your own home and getting a home equity line of credit on it is a very important key. And if you don't already own your own home, then step number 1 is generally just get into your own property, your own residence, and own that. And then eventually over time, looking at putting a home equity line of credit on your residence. In the last presentation, we did talk about a bit of a few different strategies with regards to how to build a real estate portfolio aggressively and quickly, which sometimes actually doesn't involve getting a home equity line of credit on your residence. It involves you buying residence after residence and keeping a trail of properties behind you that you actually purchased with less than 5% down. And the last thing that I really wanted to highlight in the kind of a summary or overview is structuring your income properly, especially if you're self-employed. And the reason for that is that we showed a slide last month, and it was this slide here, which is buying your 4th and 5th property. And the reason that I have this up is if you bought 5 properties in total, and each of them was a $500,000 purchase with $100,000 down, so $2,500 a month rent on the rental. Even though these properties would likely cash flow neutral or be about even, you'd actually need about $150,000 to $220,000 in household income in order to qualify for that. So you do need a fair bit of income. And so one of the things we talk a lot about is creating and structuring your plan to be able to qualify for as much properties as possible. But of course, as you build your real estate portfolio, getting up to 4 and 5, great. But we're here to talk today about how to get 5+. And if every single property you need to continue to add more and more income, it gets less and less realistic for you to be able to build it and grow it. So something that I really want to hammer out is how do you build it past 5, especially if you don't have a large amount of income that you could use in order to keep growing it. So let's talk a little bit about some of the key points and a few things that we left off the last presentation with, because it's a good launching pad for us. And let's go here. So a couple of the key points that I looked at, lender guidelines vary and they stack with more properties. So what I mean by that is that different lenders have different guidelines. And in fact, most lenders have completely different guidelines when it comes to qualifying for rental properties. And this is where you'll find that if you're a standard first-time home buyer, you really are focusing more on rate because that's the one of the very few differentiating factors, other than things like prepayment privileges and mortgage penalties, as a first-time buyer. But when you're an investor, the products can vary quite a bit, and more importantly, the qualifications can vary quite a bit. One issue is that when I say that the guidelines stack, I mean that if you are trying to buy your 5th rental property and you're using a lender that doesn't use a lot of rental income, that little negative that each rental property will show up on your file is going to stack. So you have a negative plus another negative plus another negative plus another negative, and it keeps stacking up. It becomes harder and harder for you to qualify with that particular lender if you're not reusing the right lender. So one of the things we'll talk about today is how do you choose the right lenders and how you structure the portfolio in a way that allows you to keep qualifying. Something called the DCR becomes more relevant in some cases. I will talk about what DCR is a little bit later in the presentation. For those of you that already know, it's a method or way of calculating the rental income. It stands for debt coverage ratio, and I'll get into that in a little bit because I do have a slide that talks more specifically about DCR. Liquid assets are being put under the magnifying glass, and so as you grow your real estate portfolio, you're going to find that lenders start to really look at how much do you have in liquidity. If a lot of negative things happen at the same time, do you have enough liquidity to withstand that? And the reality is, the more rental properties you have, the more negative things that could be happening at one particular moment. If you have 10 rental properties, the chance of you having a couple of tenants that have left in the properties in a bad state, and you have to put more money into them just to renovate them and be able to re-rent them, that is a potential concern. On top of that, maybe you have a couple of places that are just vacant in general, or you have a couple of short-term rentals and it's wintertime in a summer area where you're not getting as much rental income. And so you do have to have more liquidity as your portfolio grows. And that's something that gets put under the magnifying glass. And some lenders are very black and white on that. They say, we need a specific amount. A general idea is about 30 to 50 grand per property. And some lenders are a little bit more loose on it, and they make a judgment call on it. But the reality is they will start to look at your liquid asset net worth in order to be able to continue to grow the portfolio. So that's something that you're going to have to keep in mind. Another thing you're going to have to keep in mind is that many lenders have the 5 max rule. And a lot of you have probably heard about this. If you've been looking at investing in real estate, you hear that, oh, I can't buy more than 5. Well, yes and no. So a lot of lenders do have a max or limit of 5. And we'll actually get to that because there's a couple of specifics to that. It's not just 5 in total. It's not just 5 in general with that lender. Different lenders will have different guidelines, but there is some truth to that 5 max rule. So we do want to figure out how do we break through that. So we've talked a little bit about about your first venture, buying up to 5 properties. I want to focus now more on getting 5 plus. How do you get past 5? And we're going to talk a little bit about how commercial could be a component of that. But first, let's get to planning and purchasing properties 5 to 10 and how important the planning part is. And one of the really important things here is it's necessary for you to more clearly define your goals. I find that a lot of people come to us and say, hey, I'd like to buy some rental properties and see how it goes. And it is tricky. And one of the main things and reasons that this can be tricky is that after you've clearly defined your goals, you're trying to then speak to some professionals to get input and help create your game plan. It's very difficult if you don't know where you want to take it. And so that's why you have to really have the power of intention behind you to figure out, okay, this is my goal, this is my objective. I want to grow it to 10 rental properties or 20 rental properties, or I just want to buy 5 or 6 and that's it. It really helps to understand what your objective and what your goal is. And the more clearly you can define that, the easier it is for you to build that portfolio by speaking to professionals, getting the right advice that's tailor-made to you. And then you can go ahead and initiate a game plan and get things started. And another thing that I really want to hammer home here is initiate the game plan. You notice here that we're in the planning phase and we've defined, if we're going in sequence here, we're defining the goals, we're speaking with the professionals, and then we're initiating the plan. There's nothing about going out and buying rental properties right away, is there? it's really important to make sure that you say, okay, if you're going to incorporate, let's go and incorporate and set up the corporation and get everything set up. You need to do all of this and lay the foundation first so that you can start to build your portfolio in the best possible manner. So when I'm talking about professionals, there's really a few core planning professionals at this stage of the game. First one is a lawyer, and the lawyer's going to go over a couple of things with you, like liability protection, corporate structuring is very, very important, and estate planning. And these are all important keys. And depending on where you're at with your investing career and where you want to take it, the liability protection, sometimes adequate insurance is good enough, and maybe you don't need to get an incorporation set up. Maybe you don't already own corporations and you don't plan on setting up any corporations, and so corporate structure may not be relevant for you. But estate planning may still be relevant for you one way or another. And figure out where you're going to do that in a personal name or a company name is something that you do want to start thinking about at some point in your investing career. And again, it's one of those things that's a lot more expensive and more difficult to change later on once you've already been growing and building it. The accountant is one of the most important things here. And not because I'm a math geek, which I am, but it is something that I find at our office. We probably talk about taxes more than almost anything else outside of the realm of obtaining an actual mortgage, and that's because there's so many pieces that are integral to this, and there's a lot of ways you can set up the financing in order to be tax efficient or not tax efficient. And so it's really important to talk to the accountant and go over your tax planning, especially if you're trying to figure out like what is the best way to minimize taxes. One of the challenges we have is the accountant, if they're doing their job, they're minimizing your taxes, and the mortgage broker, in order to achieve their objectives and their job of getting you the biggest mortgage possible, in many cases, especially if you're an investor, getting you qualified for the maximum amount of credit, the accountant's pushing down your income and the mortgage broker wants you to push up your income. And there is a fine balance here where if you get the mortgage broker and the accountant to talk, you can figure out what the minimum required income is in order to be able to qualify to achieve your goals and objectives, so you can save as much money as possible in taxes, but still be able to qualify for mortgage debt. But you really have to go over some tax planning with your accountant. This also loops into should you be incorporating or not, and the accountant's a very, very important professional to be incorporating into these plans. And then, of course, estate planning. If you're going to set up a company or not, this is another thing that often the accountant gets hooked into, because you do need to understand the taxation pros and cons for the different structures and different strategies. And of course, mortgage broker. Yes, I'll toot our own horn here, but none of these things are really relevant or possible if you can't get a mortgage. And we've seen this happen a lot where our clients are going out, setting up a big corporate structure and then approaching us, and we realize, well, now that you want to set it up in a company name, there's not a lot of options available for you to get financing. And so this is something that's really, really important. You have to look at your qualifications too, and where you can take things. It is not easy to get qualified for financing, especially when you have 5+ rental properties. In fact, there's a large drop off in the number of lenders that are available to you once you get over this hump. And so looking at your qualifications, working with your accountant to structure the income planning if you're self-employed, determining how much income to claim in order to be able to take that next step. And a very important feature of this too is the proper lender selection, which we'll get into in a little bit. So something that's it's important to make sure that when you're talking to these professionals, you try not to isolate them into silos. You really do need to make sure that you're speaking to all of them, and everybody is working together on the plan that suits your overall objectives. But as I said earlier, keep in mind, you have to be very, very clear of where you want to take it. If you say, hey, accountants should incorporate, it depends. And frankly, I've talked to a lot of accountants, and guess what answer we always get? It depends. And the problem is there's so many inputs and so many reasons why it may or may not make sense for you to incorporate. So the clearer you are with where you want to take things, because the accountant can ask you questions all day long about where you are today, but it's important then to figure out where you want to take things, because ultimately that is the objective, is taking you to your end goal, and figure out, well, if you want to buy 20 rental properties, then maybe we should set up a corporate structure. So I want to address the elephant in the room, which is to incorporate or not. It is a confusing thing. And again, you talk to an accountant. In fact, you talk to 3 different accountants, you'll get 3 different answers. That's how complicated this can be. So it is not easy to answer this question, but I'm going to try and break it down as simply as possible. And first, just talk about the different ownership options available to you. So if you're purchasing a property, you can purchase it in a personal name. That is the most standard way of purchasing rental properties. And frankly, that's the way that most of our clients do purchase rental properties. You can purchase real estate in a holding company name as well. And you can purchase in an operating company. So holding company means that it is just holding assets, just holding real estate in this case, or holding cash, or holding whatever it is, but it's holding something. Or also referred to as a non-active corporation. It is not actively conducting business and generating an income from it. An operating company, on the other hand, is a company that is going out and doing things to generate an income. So for myself, for instance, I have a holding company called Greener Holdings, and that holds my real estate holdings in it. I have an operating company called Green Mortgage, which goes and does things like holding webinars on my holidays to generate an income. So different companies will have different forms of different uses. One of the reasons you actually don't want to mix these up is an operating company has liability. So if I'm conducting business in my operating company and then I get sued, I don't want to hold a bunch of real estate assets that have a bunch of equity in them inside of my operating company, because now those are at risk and being exposed to potential lawsuits. So it's important to separate that. The holding company generally is where you're holding the assets and they're sitting there. And this is what the liability protection that I alluded to a little earlier that lawyers would go over with you, is making sure that your assets are separated and in different buckets. So again, you can go personal, holding company, or operating company, and those are the 3 forms of holding real estate. There's one fourth one, which I personally am not a huge fan of, and there's some big changes to that. But there's another way that you can hold real estate in trust for one of these entities. So I can buy something in my personal name and hold it in trust for a holding company or an operating company. For those of you that have done that in the past, there's a couple of reasons that is difficult. It is more difficult to get financing on subsequent purchases, which is one of the reasons we don't like it. The other reason that we don't like it is more recently there was a new guideline or rule that came out called the BC Transparency Act. So if you're in British Columbia, they have a Transparency Act now where you're needing to disclose any holdings you have that you're holding in trust. And we don't really know what the implications of this would be. We expect that banks and other institutions will have access to this, and it may cause some challenges moving forward. So, not our proposed method. Very for a very short period of time back in 2012, I think that we were advising clients, and then in 2013, all of a sudden, lenders started to change their tune a little bit and said, "Oh, by the way, we need to see." That all properties, if you hold rental properties, that the income is on the tax returns. And guess what? If you had the mortgage in the personal name, you're holding in trust for the holding company, the income does not show up on your personal tax returns. It shows up in the company. And there are a few lenders in particular that are very difficult to get around this, and they don't recognize the trust agreement, which means that they take the full liability of the mortgage, but they don't take any of the income because it's not showing up on your personal T1s. It's showing up on the corporate returns. So long story short, we don't generally recommend that option. So let's get into the fun stuff. Tax. All right. So in personal name, it is easier to get financing. Tax rates will vary between 20 to 50% depending on your income tax bracket. The average in Canada is about 41% tax bracket. So buying in a personal name, you can expect to pay about 41% tax. Holding company. It is harder to get financing in a company name, and generally you're looking at higher rates and/or fees with many lenders. And the tax rate, believe it or not, is actually higher. And we'll get to why you would still buy in a holding company shortly. But the reality is it's actually more expensive tax-wise for most individuals in Canada, just based off of the income alone, to actually hold it in a holding company than it is to hold it in a personal name. So why do people do it? We'll get to that. Operating company. This is almost impossible with a bank on the residential side, by the way, I should say. In commercial lending, if you're buying your own location, then you can absolutely do that in an operating company name. However, even in those cases, it's not very common. We'll find that in general, many companies will still purchase a property in a holding company name, even though their operating company is residing in it. And again, it's because of that liability protection. Um, but with, I think, one or two lenders, it is still possible on the residential side to do this. One potential benefit is that the tax rate is much cheaper. But I will say that in general, with most lenders, they do say that, you know what, if we know that it's an operating company, then we will not lend to it. They want to lend to a true holding company because they don't want their assets being at risk if you are conducting business and then you get sued, and all of a sudden their assets are frozen and they can't proceed with a foreclosure because your entire company is frozen because you're in a lawsuit. So it does make things a lot more challenging for you to be able to buy in an operating company name. One of the areas that we do see operating company name purchases, though, would be flips. And the reason for that is a flip is actually an active income. You are doing something to generate the income. And the lenders that are more open to lending in an operating company name would be commercial lenders and also private lenders. And we often find that for many reasons, it is more difficult to get residential lending anyways on flips. Even commercial lenders quite difficult, but private lenders are very open to it, and that's one of the things that they're very good at. So higher rates, higher fees, but that might be offset by a much lower marginal tax rate by buying in the company name and an operating company name. So something to keep in mind if you are thinking about doing flips, but think about doing a lot of them. I wouldn't suggest setting up a company, doing one flip it, and calling it a day. I think that you'd have to demonstrate to the CRA that this is a business of yours and you continually do this as a source of income. All right, I'm going to get into some more complicated stuff. So let's look at this structure here. And this is there's actually four corporations that are all owned by an individual. And this gets a lot more complicated, but I want to illustrate why people set up holding companies, and one of the primary reasons to do this. So if you have an operating company, what often happens, you make money in your operating company, and then you push that income up into your cash holding company. Now, the key is, what do you do with that money once it's there? Well, the first thing is, you're not actually going to move it from your cash hold co to yourself personally. Where you're actually going to do is you're going to actually lend it from your cash holding company. Or a lot of the time, guys, it's actually, you're not even setting up a cash holding company. So you're just going to go right from the operating company and either going to yourself as an individual or right to your holding company as a corporate entity. But either way, the money is moving from the operating side to the holding side. And when you're doing this, the reason for this is that if you took the income home and you paid it out from your operating company, even if you float it through this holding company first, you're going to now pay personal tax rate on it. So let's use an example. If you had $100,000, and if you had $100,000 and you paid yourself that $100,000 out of your operating company, if you're at 40% tax, let's say, now you have to pay the tax on that 100 grand. Now you have $60,000 left. And now you take that 60,000 and now that's your down payment. So now your maximum purchasing power is $300,000 if that's all the cash you had, because $60,000 is 20% down on a $300,000 purchase. Now let's look at this in a bit of a different light. If instead your cash holding or your operating company made the income and kept the income inside of it, paid tax on it at, let's say, if your small business rate, that's about 11%. So now you have $100,000 gets whittled down to 89,000. Now you lend that $89,000 to your holding company and you're lending it. So it's a different transaction. It's not an income in general. And sometimes it is, but in this case, it's not. You're just lending it to your holding company. And then your holding company is going out and purchasing the real estate. And now you're using $89,000 for down payment. And so now you're getting up to just under a $450,000 purchase. So your borrowing power and purchasing power has now increased because you have a larger down payment. So it's just a bit of a different structure. In addition to this, this very bottom one here, the Real Estate Consulting and Management Corp, I will say that it's very challenging to be able to get this set up. And this is at, I wouldn't say extreme scale, but it's at much larger scale. The information that we get from accountants is that you generally have to have at least 5 full-time staff in order to be able to set this up. And that's like an automatic check mark where you qualify for this, or there's other things that you can set up in order to be able to do this. But there's a lot of things that you have to exemplify that this business is an active corporation. You're not just using it to funnel your income from a high tax rate to a low tax rate. But essentially, in theory, you have this operating company which invoices your holding company for the amount of income that your holding company is earning. So if you have made $10,000 in the holding company, you'd invoice the holding company $10,000, and you're shifting that $10,000 income from the holdco, which is a 50% tax rate, down to the operating company, which is only 11% tax rate. So you're shifting the income from the high tax rate to the low tax rate. And again, this is where, this type of structure, people, is a much larger scale. Okay. And this is why we say it's really important to know where you want to take this. You're not going to go and set up 4 different companies if you're going to buy 3 or 4 rental properties. It just doesn't make sense. You'll be paying a lot of money each year just to maintain all of these companies. And for what? You won't get the economies of scale to make this beneficial for you. But if long term you're planning on really growing things, these types of structures can really benefit you, especially if you're planning on buying 20 or 30 properties. So all of this tax stuff, I'm sure it's getting you a little confused, and I might actually be losing you, and you're looking around and wondering what is going on. This guy is going on and on and on about taxes, and you're looking outside and it's beautiful and sunny and wondering, what am I doing right now watching this presentation? All right. So let's just nail this down and look at the pros and cons of buying in the company name versus not buying in the company name. So if you already own an operating company already, that's one of the best reasons to set up and buy real estate in a holding company name. And that's because you already have the operating company set up right now. And so you already have that structure where you're earning an income inside the operating company, and it may make sense, not always, but most of the time or a lot of the time, it can make sense for you to just set up a holding company, and then that company is where you actually purchase the real estate. If you're looking at going a much larger scale, that's another reason to do it. And then for many different estate planning reasons, it can make sense to set it up in a company name. There are things called estate freezes and whatnot, and other ways of allowing people, and this can be family or it can be other joint venture partners or whoever, to buy into the company and buy pieces of that company, as opposed to you owning it personally. And it's a much more difficult transaction to do that. But on the con side, the cost is about $1,500 per year per company. It's harder and more expensive to get financing, which is something that does have to be factored in for sure. Sometimes some lenders will actually do this under their commercial division instead of residential. Even if you're just buying a regular condo or a house that's clearly a residential property, many lenders will actually say, well, because you're buying it in a company name, that's actually a commercial mortgage now. So instead of getting a rate of 2%, now the rate is 3.5%. Oh, and by the way, we have to charge a 0.5% fee. Oh, and by the way, we have to charge what's called an annual review, which is $500 a year. So all of a sudden you're realizing, oh my gosh, my costs are really starting to increase. And again, as a mortgage broker, we can direct traffic and figure out, well, who's doing company name mortgages on the cheap. But I have been noticing that over the past decade in particular, it's becoming more and more difficult and challenging to get financing in a company name as opposed to personal name. Another thing that's important too is residential lenders do not lend to multi-tiered corporate structures. And what I mean by that, and it's something that I've had for some reason the last year or two has come up quite a bit. If the holding company that you're purchasing the rental properties underneath is owned by anybody but the borrowers on this mortgage, then they will not lend to you. So here's a common thing that we have face us. The holding company is owned by another company, which is then owned by the individual. Very difficult. We do have 1 or 2 lenders that will look and follow the trail all the way up to figure out who is the owner at the top of the pyramid, so to speak. But in most cases, like 95% of lenders, they'll say if the individuals are not the owners of the holdco themselves, then they will not lend to that company. So very challenging. Another thing that we see quite a bit too is the holding company is actually owned by a family trust, which again is a no-no. As soon as we get into the family trust and there's beneficiaries and, oh yes, my children are beneficiaries of our trust. Now things get a lot more complicated. Oh, my children aren't old enough to co-sign on a mortgage, by the way. So things can get a lot more tricky and complicated. Again, for residential lending, you're going to find on commercial lending and small business lending that things can be a little bit more flexible. But again, you're getting into a higher cost. So it's something to consider. If the tax benefits are outweighing it, or if the scale and the sheer magnitude of how big you want to grow this is more important to you than the cost of per transaction, then it can make sense to set up a company name. So another thing we need to look at here is how to set up your personal finances and making sure you can qualify. And the reality is, if you look at this line here, every property that you own requires a higher income in order to justify and to be able to cover. Even if you're buying strong cash flow real estate, most lenders only use a certain percentage of the rental income to help you qualify. So how do they qualify you? Here's how most lenders look at it, especially when you're starting off and in the first early phases of your portfolio. Many lenders use what's called a 50% add to income method. So let's say that you had a $1,000 a month rental income coming in. Most lenders would take 50% of it, add it to your income. So now they've taken $500, they've added it to your income. But again, most lenders only use about 40% of your income. So now they're using 40% of the $500, which is $200 a month. So $1,000 turns into $200 a month for borrowing power, not a lot. There's an 80% offset or just an offset in general. Different lenders have different percentages, but some lenders are up to about an 80% offset. An 80% offset means that they take the rental income and then they offset all the expenses against it first. And then whatever is left over is either surplus income or is a liability. In this example, an offset, you're actually using $800 of that rental income. So substantially more than the 50% add to income method. It's actually 4 times more income being used. And then there's the DCR, which stands for debt coverage ratio. And what this is that they want to see that your portfolio, so all of your rental properties and the property that they are financing, is cash flowing on a 1.1 or 1.2 to 1 ratio of income to debt. So different lenders have a different requirement for this. It's between 1.1 and 1.2 in the residential side. On the commercial side, it's about 1.2 to 1.25 typically for residential real estate. And what they're looking for is that the portfolio must generate a surplus of income. One challenge we have, though, is when the lenders came out with a stress test a few years ago, now all of a sudden, putting 20% down in major urban centers like Vancouver, for instance, it's hard to find properties with cash flow in general. And then on top of that, you add on the lenders using their own metrics for expenses. And you add on another key feature, which is that they're using the stress test. And right now, the stress test is 5.25%, as opposed to the actual interest rate you're getting, which is about 2%. So the problem is that really, if you're supposed to put 10 or 20% back in your pocket with factoring in stress test mortgage payments and all of the expense ratios that they're using, it'll be very, very difficult to get 80% leverage using a DCR. So the reason that lenders sometimes use DCR, and the reason I'm bringing this up, is that many lenders, when you start to build a portfolio of a certain size, they start to transition and they change the way that they look at your file. And it's a DCR really is a commercial lending way of doing the analysis. But as a real estate investor, as you grow your portfolio, it does become more like a business, and they want to see that the properties are all producing positive cash flow. So again, the subject property, so the one that you're financing, so the purchase or refinance, and the overall portfolio are going to need to be 1.1 to 1.2. So what are some of the challenges that we find our clients are running into? So a large portfolio is one of the big challenges. Over 5 rental properties is tough. Professional landlords are not okay. Very, very challenging to get this done on the residential side. If you have quit your job and you're thinking, and here's the reality, you go to any of these sessions and you start drinking the Kool-Aid, and they say, hey, within 2 years only, you're going to buy 100 properties and then you're going to retire and everything is going to be all rosy. Awesome. But the only problem is if you want to buy the 101st property and now you've retired, it's almost impossible to do that on the residential side. So a lot of the time people think I'm going to buy a couple of rental properties and then I'm going to retire and then I'm going to buy some more. The reality is you probably need to try to qualify for as many properties as you can before you retire, because as soon as almost all of your income is real estate related, the lenders start to back off and say, hey, even though it's positively cash flowing, we can't help you. What we do find is that there are larger liquid asset requirements for larger portfolios, as I had mentioned earlier as well. Low income is another challenge that we find that is a bit of a challenge for our clients with this many properties. The stress test is at 5.25 right now. There are a lot of requirements from the government for financing to be income qualified. I've been a broker for 15 years as of November, which is crazy. But in the very beginning of my career, you could put 25 or 35% down and you can qualify for a mortgage almost no problem. And today, it's much more challenging and much more difficult to do that. The government does not like to qualify people strictly based off of their down payment. It causes a bit of a domino effect where if too many people qualify for real estate that they couldn't actually carry the debt on, and they're just hoping that the values would increase because everybody and their dog can go buy real estate, that if the values increase, they'll just refinance in 5 years, take some more cash out, and just use that to service the payment. So the government's not super keen on that. And that's why they keep tweaking the required income via the stress test to make things harder and harder for people. Now, again, there are some net worth or self-employed programs that can help alleviate a low income situation. And on complexity as well, this is a challenge. Again, when you're getting into 5+ rental properties, there is more complexity, and buying in a company name, especially a multi-tiered corporate ownership, holding in trust. There's a lot of extra things that come up, and these are some of the challenges that our clients trying to buy 5+ properties run into, and can be a bit of a challenge. So here's a couple of tips that I actually showed on the last presentation I did too, but it's really important to hammer this home. It's all about debt servicing, and I can't stress this enough. The reality is, the bank doesn't care if you're putting 50% down. You have to be able to debt service it. They don't care if your residence is worth $3 million and you only have a $500,000 mortgage on it. If you only make $25,000 a year on paper, your income can't even service your own personal mortgage, not to mention adding more debt on a rental property. So it is all about debt servicing. You have to remember that. And so you need to do everything you can to make sure your debt servicing is as good as possible. And a couple of ways to do that is take a 30-year amortization on all debt, all of it. In fact, on all of your rental properties and any money borrowed against your residence to purchase rental properties or make investments, that money is all tax deductible anyways. And so yes, you have a higher interest cost if you take a longer amortization, but that money is tax deductible, which helps counterbalance that. And keep in mind, you can always make lump sums on your mortgage. So if let's say that you'd like to make $10,000 a month on your mortgage payment, which is quite high, but let's say you have enough cash flow to do that. If on a 30-year amortization, your payments are only $3,000 a month, you can still make lump sums of $7,000 per month with the right lender and just chip away at that mortgage. But on paper, when you go to qualify, you don't have a $10,000 a month payment. You have a $3,000 a month payment, and it makes it a lot easier for you to qualify. So something to keep in mind. So another thing, eliminate all other high interest debt. So let's give you an example. A car loan for, let's say, about $25,000 with a $550 a month payment is the same as borrowing $100,000 on a mortgage. Another example, a credit card or unsecured line of credit, they use a 3% of the balance as a repayment. So in that example, about a $20,000 payment or a $20,000 balance on a credit card would be a $600 payment, which means that it would require about it would be the same as borrowing about $110,000 on a mortgage. It's quite substantial. So just keep that in mind. Often this is where when we sit down with a new client, step number one is usually restructuring all of the debt, rolling it all into the mortgage, and then getting a bigger line of credit if possible, so that then you have money available to invest. And the reason for this is that you need to maximize your debt servicing ratio and make sure you have as much room as possible to get out and get the next one. So getting a HELOC should be step number one. And so again, we tell our clients, if you already have one and you can qualify for it, then you should be starting to set that up. Making sure that you follow the game plan. That's one of my favorite sayings. Again, if you plan to, or fail to plan, you plan to fail. And if you are self-employed, chat with your accountant and broker annually to determine the income claimed on your taxes. And so it's really, really important to be able to do this. I'm actually working on a nerdy, dirty spreadsheet that will help you and your accountant, if you're self-employed, do this automatically. We're going to try and roll it into a much larger project of ours, but it'd be an amazing tool to allow you to punch in what your annual taxes were filed at last year, what you'd like to qualify for this year, and then it'll reverse engineer how much income you need to file on your next year's taxes in order to be able to qualify for that mortgage. And it'll also tell you how much tax you'd have to pay in order to qualify for that mortgage, because sometimes the amount you'd have to claim is so high that it doesn't actually make sense for you to claim that much in income. You're better off paying less in income tax and paying more on the mortgage rate. And again, it depends on your personal situation. It depends on whether you're really close. Maybe you just need to inch up your income just a little bit. But if you're really far away, sometimes it just makes sense. Go with a B lender, go with a private lender, pay extra in interest, but save money in tax. But in general, if we're talking about the 5+ rental property clients here, we're talking about potentially borrowing millions of dollars. And when you're borrowing sums that size, it really is important that you limit it and really reduce your overall interest costs as much as possible. So at this point, you're getting through this. You're starting to feel a little good. You're thinking, okay, yeah, I can do this. I can get 5+. Yeah, it's pretty difficult. So it's one of those things where as soon as you've been declined, now you're figuring out, oh my God, this is way harder. I've now hit the wall. So I want to talk a little bit about 4 of the most common 5+ rental property challenges. And then I'm going to talk about solutions, because I know that's why you're all here. So 4 most common challenges: a low personal income. Professional landlords, those are really tough to finance. Self-employed, really tough to finance too. Again, though, if you're self-employed, you can still figure out what income you need to claim on your taxes to be able to still qualify for mortgage debt. But this is a common issue with self-employed borrowers and people that decided to become a professional landlord. So it becomes more challenging, of course, to do this. Portfolio cash flow. Too many speculation holds or development plays are holding you back. Again, if you have to qualify using that debt coverage ratio, or again, if you have a few development plays or speculative investments in your portfolio that aren't producing cash flow, guess what? As I talked about earlier, that negative cash flow is stacking on top of itself, and it's becoming more and more difficult for you to qualify for that debt. The sheer number of properties. So I alluded to this a little bit earlier, but a lot of lenders have a 5 max total, where they just say, if you have 5 properties or more, we can't help you. Some lenders, however, say, well, we don't have a maximum, or maybe their maximum might be 10 properties, but you can't have more than 5 with us. And some lenders also have something called the maximum aggregate, which I have another slide that we'll talk a little bit about that too. But the number of properties in total that you have is one of the biggest challenges, and that's often a hurdle, and it starts to reduce the number of options and lenders available to our clients. And then the last one that I run into too, which is liquidity. And I would say that this is probably in order of the things that are most difficult, meaning the low personal income is the most challenging issue to get around. You can solve a lot of things with a high personal income. The next step is, portfolio cash flow, because obviously that starts to stack against you. The number of properties, just limiting the number of lenders that you can talk to in general. And then liquidity is something that, again, a high personal income can often offset a low liquidity, because if you don't have a lot of cash in the bank today, if you can say, well, yes, but I generate a lot of cash on a monthly basis, it does help to offset that concern. And as I mentioned earlier, 30 to 50 grand per property is a good target. So let's talk about solutions, because there's always a way, right? So let's figure out how we can break through that barrier and get you from 3, 4, or even 5 properties and right up to 10. So step number 1, and one of the things that's very important, is the proper lender selection. It is very, very difficult for you to grow a real estate portfolio if you just keep going to the same lender every single time, and you might actually be using a lender that you should be preserving for later. So as I mentioned earlier, some lenders are max number of properties total, some are maximum number of properties with them, and some are maximum aggregate lending with them. So some lenders will say, well, you've got over $2 million in lending, so it has to go to a higher level of risk. And at that level, we need to see this or we need to see that. So it can become more and more challenging as you grow the total amount of debt that you have with those lenders. So in general, you're dealing with a few different things: max number of properties you have in total, max number of properties you have with that specific lender, and also the total amount of lending that you have with that lender. So one of the things we look at is we try to use lenders that we don't think we're going to need for later on in the beginning stages. And so if we know a client wants to buy 10 rental properties, we don't want to buy and go to a lender, let's say, that is good for properties number 6 to 10. We don't want to go to them in our first 5, because our first 5 is actually easier than properties 6 to 10. So we don't want to use up one of the very few lenders we have available to us later on. And when I say that the market dries up quite a bit, as a mortgage broker, we have access to over 40 lenders inside the broker channel, and we're a little bit unique where we also deal with all of the lenders outside the broker channel too. We have connections and contacts with each of those lenders, and we're still able to get deals done that way. But we're often looking at how do we set up things to use lenders that we don't think we're going to need later on, or lenders that are not currently suitable for your portfolio when you have 5+ rental properties. So try to use lenders that aren't good for 5+ and preserve them for later, and it keeps as many doors open for you later on. Because sometimes there are situations where the number of properties or the number of lending options drops off a cliff. And this is a tool that we made internally in-house, and we're always tweaking it and adding to it. But you can see it actually highlights lenders for us in green, red, or yellow, depending on where the client may fit with these lenders. And you can see that with some lenders, the debt servicing is only 34%. With some lenders, it's as high as 60 or 65%. So it really makes a big difference. And this is something I talk about, which is that every lender's policies and guidelines vary quite a bit. And it's our job to make sure that we're staying on top of it to be able to monitor that. And that spreadsheet actually is something that we're tweaking and adding to, but always making sure that we find an option for our client. So most mortgage brokers are just going to shop inside of the 40 lenders that are inside the broker channel. But we do find, especially when you get to properties 5+, you're actually shopping lenders outside the broker channel too, because your options go from 40 down to like 3 or 2. Not a lot of lenders really like to do that, especially if you're just focusing on inside the broker channel. That's where some of these are dealing with some lenders, small business divisions, commercial divisions. Certain banks are more open to it, and they may not be inside the broker channel, but we can still underwrite your file, and we have contacts there that are very good at getting complicated deals done. So we underwrite for everybody, and we can deliver our client options and ultimately find a solution. Now, we've gone through a number of different things, and a lot of this is all talking about residential lending. I do want to talk about commercial lending as well before we wrap things up. So commercial, what is commercial? If you're buying residential and it's 5 or more units, then that is typically considered a commercial mortgage. If you're buying like a retail strip mall, that's commercial. Industrial warehouse, that's commercial. And development would also be considered commercial. So basically anything that's not an existing 4-unit or less residential property is going to be considered commercial. So it's probably easier to define commercial not by what it is, but what residential is, because residential is only 4 or less units and commercial is everything else. Now, I talked about the DCR, but I'm going to remind everybody what a DCR is, because this is really relevant. And this is one of the really important reasons that a lot of our clients do start to transition from residential to commercial as they grow their real estate portfolio. Because in commercial, the lender cares far more about the income that the property generates and far less about how much personal income you have. And so they're looking at, we want our debt coverage ratio to be 1.25. And let's say that the property is generating $125,000 in income and has operating expenses of $50,000. That means that if they need a 1.25 to 1 ratio of income to debt, that means on $125,000 in income, they can only have a maximum of $100,000 in expenses, including the mortgage they're going to give to you. So if they already have 50 grand in expenses, in operating expenses, then they would only lend to you an amount where the mortgage does not exceed $50,000. Now, in some markets, this can kind of achieve 75% lending, which typically is the maximum. That you can go CMHC insured on multifamily buildings, and technically you can get as high as 85% financing, but it's very, very challenging and difficult to do so. But in general, commercial is usually tapping at 75% financing maximum. But you're going to find that in major urban centers where the cap rate is a function of how much income that property would generate if you bought it with cash. If the cap rate is quite low in those markets, it means that you're generating a very low income, which means that if there's not enough income, it's not going to qualify for a very large mortgage. So it becomes very difficult and challenging for you to get high leverage in the commercial game sometimes. However, if you retired and you're one of those people that have purchased 10 properties and now you're retired, you're going to find that commercial lending is where make sense lending still exists. Residential, not so much. Commercial, though, commercial is where there's a lot more flexibility and freedom, as long as the property is cash flowing. And in fact, they will view your larger real estate portfolio as a plus, not a minus, which is awesome. They view that if you have a lot of rental properties, that is a good thing, not a bad thing. Whereas you're going to find on the residential side, the more properties you own, the worse it is for you. Another thing I want to talk about, joint ventures, and this is something that again becomes more prevalent as you build your real estate portfolio. A lot of people figure, oh, how am I supposed to get past the 5 property mark or the 7 property mark? And eventually, your borrowing power does start to get squeezed. And so that's where we start looking at joint ventures and how do we do this. So I usually like to break down a joint venture and look at the 4 different ways that you bring value to a joint venture. Number 1 is bringing cash or down payment to the table. Number 2 is being the deal manager. Number 3 is being the deal finder. And the 4th one is being the qualifying partner. So each of these brings value to the equation. Now, who is bringing what value to the equation? That is to be determined. I've seen somewhere the cash partner is getting only 25% for bringing the cash to the table because there's a heavy management and heavy management aspect, or the deal is very, very good. Sometimes we see deals where the cash partner is 50% or even more than 50% of the deal. So it really comes down to negotiation, but also is the deal so good that if this cash partner doesn't do it with you, then you'll find somebody else. It really comes down to finding the right mix. Like running any other business, it's important to make sure that you're finding people that are bringing different components to the table. There's no point in you going out and finding a joint venture partner who has cash but can't qualify for a mortgage if you have cash and can't qualify for a mortgage. You guys are still in the same boat. So it's important to find other people that can bring strengths to your situation, and often have different weaknesses too. Now, one of the things I like to say is anyone can do it, but there's a couple of things that you need to make sure that you're doing in order to set up a successful joint venture. Very important to get a joint venture agreement done. Get it done with a lawyer. If you need a recommendation, I have a lawyer that I've done a number of joint ventures with personally. But it's very important to get a structured joint venture agreement done. It goes through all of the potential issues that could come up, and just make sure that you're not going to run yourself into a situation where you get yourself in trouble, especially if you haven't discussed anything. And it does go over the tough stuff. What happens if somebody gets hit by a bus? What happens if a partner wants out, right? It's very important to have that structured though. Another issue that we find on the mortgage side is the qualifying partner must have the down payment. That means the cash partner can't just say, oh, here you go, qualifying partner, and pop some cash in that person's account. The bank's going to look at that qualifying partner, look at this random lump sum of money, say, oh, where'd this come from? Oh, my joint venture partner who's not on the deal. Yeah, we're going to want that person on the deal. So keep in mind that the qualifying partner must also be the one that's bringing cash to the table. Another important key is that networking is key. I do find that in order to set up and structure joint ventures, it's really hard to go out and find people that you've never met before and convince them to give you money, especially if you're asking for money. So networking is very key. It's very important to join as many investment groups as you can. Come into things like this, chat with people. You should be paying attention to me, but it's okay if you need to chat with some people that have attended here, as networking is a very important key. And as I mentioned earlier, find a partner with different strengths than you, because again, you're not doing yourself a lot of favors if you find somebody else that has the same profile as you do. Now, remember, game plans can vary person to person, and a game plan for 5+ properties can be very different and vary in many circumstances. I have some clients, we were just working with one recently that has 15 rental properties in his personal name. Yes, they're all in his personal name. And that goes counter to what you'd typically expect. He actually also owns an operating company, and yet all of his properties are purchased in his personal name for various reasons. So sometimes things do go against the grain. There is no one box fits all type of solution for everybody, especially in the tax side of things. So that's where it's really important to engage the professionals that I mentioned: lawyer, accountant, and mortgage professional, to figure out how you can structure your game plan and take you from where you're at to where you want to be in the future. And again, it can be very, very difficult, but we do try to make it easy. And we try to break it down into bite-sized steps and just say, okay, don't worry about it. What's step number 1? What's step number 2? What's step number 3? We built out a lot of tools and things that can help our clients make educated decisions. One of the things that we say is it's always good to book a consult with us and just figure out where am I, what do I need to do to grow? How do I keep proceeding and building my portfolio from here? We do talk a lot about deal analysis as well, and not only just how do you get financing for your rental properties, but how do you actually analyze and look at what is a good deal and what's not. There's a couple of shortcuts that I like to usually go over, just to make sure that everybody knows these. But one of the shortcuts that I often look at is just using a rent to price ratio. Different rent to price ratios work in different markets, but I do find that in major urban centers, it's usually not getting it much better than 0.4%. In fact, something in Vancouver might be only a 0.3% rent to price ratio. What do I mean by that? If the rent is $3,000 a month and the property value is $1 million, yes, typical Vancouver condo, that would be a 0.3% rent to price ratio. So the monthly rent divided by the purchase price. In different markets, like in Edmonton, for instance, you can find that 0.6 to even 0.7 is attainable. You go into the Maritimes, it can be higher. One of the things you have to keep in mind, though, is these are shortcuts. These are just quick hit numbers. Some of these, when you dive into the figures, in Edmonton, for instance, the rent to price ratio may sound really good until you look at who pays for the heating and how much does it pay to, how much does it cost to heat in the winter. Oh, and by the way, you have to pay for snow removal because it's an apartment building, etc. So there's a lot of other things that you need to factor in, but this is just a quick hits on how do you compare property A to B really quickly and drill it down. Another thing that we look at too is for every $100,000 that you're borrowing on the mortgage, that costs about $400 a month. So if we're looking at two properties side by side, one's $100,000 more than the other, but I think one can get $600 more a month in rent. Then I think that the property that's more expensive by 100 grand but gets $600 more in rent will probably produce better cash flow. So that's a little bit of a trigger for me to jump into that and go down the path of doing the analysis on that deal. The other things that I like to look at too is using some tools. We have a cash flow analysis spreadsheet that's designed for residential, and we also have a separate one that's designed for commercial as well. And they are a bit different. The commercial one will actually calculate your debt coverage ratio. So it actually helps you determine the maximum borrowing power on a specific property. So we're helping you and helping ourselves at the same time, because then we don't have to do all the math to tell you what the numbers are. You can actually pre-underwrite and figure out what the maximum borrowing power is for a potential acquisition. Another thing that we look at is rentometer.com. If you're looking at rents, or Craigslist, of course. I actually prefer Rentometer because it's quick hits on macro data. It's very easy and simple to use, and you can get some pretty good data on what rents are going for in the area based on it being a 1-bedroom, 2-bedroom, 3-bedroom, etc. So I do like to use that. And I also like to quickly filter things. And so it's important to use specific metrics to calculate and measure the return on investment. And frankly, at the end of the day, after you're making money from cash flow, mortgage pay down, and appreciation, those three things all add up to be your overall return on investment. And understanding how ROI is calculated, and being able to specifically filter stuff down, and also making sure that you're filtering it down and understanding in different markets what your expected ROI is, what your expected metrics would be. So maybe I'm expecting a higher appreciation in Vancouver, but higher cash flow in Edmonton. And how do I build those into my spreadsheet? And then based on those figures, does the higher cash flow in Edmonton actually balance out? And is that better for me than the higher appreciation in Vancouver? Which one makes more sense for my portfolio, et cetera? This is a quick snapshot of the spreadsheet that we have available for download on our website. This is the residential version, but we also have the commercial version. So it's great to come out to these events and sit on the computer desk and say, well, that's really good information. I'll think about it. But at the end of the day, none of this is relevant unless you turn this knowledge into action. So it's important that you start to take some action. So to get out there, get yourself your game plan, talk to your lawyer, talk to your accountant, talk to us, start to figure out what the next step is for you. Now, for those of you that are wanting to take this the next step, I've talked about this company, which is my sister company called Green Wealth, and it it's good for people that are building their real estate portfolio, but it's probably more relevant for those that are trying to build their portfolio and take it to the next level. But what we actually do is we consult on a one-on-one basis and go into talking to your lawyer with you, talking to your accountant with you, helping you structure joint venture agreements, actually doing deal review with you, and giving you feedback on the analysis, kind of being your consultant all the way through, and making sure that you're getting holistic planning all the way through the process. We help create the game plan, go through a bit of a analysis of your current situation, and there's quite an extensive onboarding process to look at, where you're at and where you want to be, and just help you grow your portfolio in the best possible way. So that company is actually created to double down and give people more advice. We do find that sometimes with working with investors, as a mortgage company, we get paid to do mortgages. And frankly, mortgages for investors are quite difficult and time consuming. And we found that, and on top of that, the advice that is needed in order to properly build a real estate portfolio goes a little bit beyond our scope of what we do day to day as a mortgage broker. And so we decided, you know what, I think that we should set up a separate program that could help people build their wealth using real estate. And so that company is called Green Wealth. Feel free to reach out to us or visit our website to learn more about Green Wealth at greenwealthcapital.ca, or email me at Kyle at greenwealthcapital.ca as well. So if you want to learn more, you can visit our website. We do have a couple of upcoming webinars. September 1st, we're talking all about private lending. And then the next one coming up after that is construction financing. In November 3rd, I think it is, we're talking about commercial lending. And then in December, the first Wednesday of December, we're talking about financing renovations. And on our website, that's where you can find all the downloadable spreadsheets and FAQs and all of that fun stuff. Also, on top of that, I know a lot of you here probably already have my book, but for those of you that do not, the first 10 people to email info@greenmortgageteam.ca, I will send you a copy of my best-selling book, Rockstar Real Estate Investing. It's great for people that are looking for those fundamentals to help grow their real estate portfolio. Frankly, it's probably best suited for those of you that are still in the 1 to 5 phase. But if you're still looking for something just to spruce up your fundamentals and just help you grow and become a better investor, then email info@greenmortgageteam.ca, and we'll be happy to send you a copy of that. And of course, if you'd like to contact us, here's all of our contact info: greenmortgageteam.ca, info@greenmortgageteam.ca, and phone number is 604-229-5515. So thank you for joining. And what I'll do now is I will open it up for some questions and go through the Q&A. So thanks for joining, and I'll start to go through Q&A now. By the way, you guys like my background or what? Christina made it for me. She said, "Oh, you can't use you can't not have a background if you're in a hotel room in Penticton." So she whipped this up in 3 minutes and made sure that there's a nice photo in the background of us holding our dog. So she makes things look pretty. I'm really good with spreadsheets and I'm really good with numbers, and she's the one who makes things look pretty. So God bless her. Okay, so I have a question from Mark, and the question is, how about a bear trust or family trust? So I've lost a little bit of context here in what the question was specifically about, Mark, but I think I did talk a little bit about bear trust or family trusts earlier on in the process about the standard ways of owning real estate. And yes, you can purchase real estate in a family trust. I don't see it often, though. I do see that normally it's in a holdco that might be owned by the family trust. So that's not very common, but that is definitely getting into more complex structures, and it is more difficult, definitely, to get financing on it if it's a bear trust or family trust. All right. Terrence has a question. For the advice to arrange a property holding company to lend money to another, would that lent money count as debt or leverage for the new company to be financed or mortgaged, which will reduce the chance of the new property being successfully financed? So no. So you are, although it's being lent, it's usually what's called a shareholder loan, and the banks do not consider this money to be funds that they have to consider as a loan repayment. We do, however, sometimes see that we might need an accountant letter, especially if a borrower is personally taking money out of a holding company or operating company. Sometimes you do need a letter from the accountant confirming that if they're taking money out of the company, A, how they're taking it out, and B, that there is no repayment that they have to make back to that corporate structure. But in general, this isn't a challenge that we run into, and isn't much of a problem. Jerry has a question. Would you suggest naming both spouses on a mortgage or keep mortgages in separate names so they can each qualify for more individually? That's a good question. And also, do lenders use small commercial financing for residential properties? If so, there would be a benefit to use. Good question, Jerry. So that is a potential strategy. The one issue I find actually is if you're removing, it only works with borrowers that have a very high household income, and each borrower has a high income themselves. So here's the problem: if we remove one of the applicants from this situation, and let's say that you have a big mortgage on your residence, the lenders are still going to, now if you remove, let's say you remove your spouse from the equation, and now it's just you going out and buying a rental property, they're going to look at that residence and say, well, even though it's owned by both you and your spouse isn't on this deal, and so if your spouse doesn't make the payment, you are responsible for 100% of that payment. And so they will factor in the entire payment on that mortgage, and that makes it a lot harder for you to qualify. So number one, that all of the household debt gets lumped in with each applicant, even if they're going on their own. And then the second thing is that each applicant doesn't always have equal income. And so if you separate it and say, okay, one applicant makes $200,000 a year and one makes 50, well, guess what? The one that makes $50,000 a year is going to maybe qualify for one mortgage, even if they have no household debt, the mortgage is paid off, et cetera. Maybe by one, maybe two rental properties maximum, be very, very difficult. So in rare cases, yes, we do have some clients where they go out and they start to build it on their own. You will still run into some banks that will say, no, we still need to see how many properties the entire household owns. And that is something that comes up. Another question that you had here, Jerry, was do any lenders use small commercial financing for residential properties? And yes, they do. So in general, there are three different ways of getting a mortgage. There's the residential channel, small business channel, and then there's the commercial channel. And what's really funny is they don't really talk to each other. If the residential can't do it, they often don't say, oh, but you know what? Small business can do it or commercial can do it, and vice versa. So you'll find that they don't really understand each other's lending criteria. They kind of work in their own silo, and that's it. They don't point you across the hallway, which would be, it's a bit surprising, but you think that they'd be better trained on that from a company profitability perspective. However, you will find that small business, there are a couple of lenders that we do a lot of business with actually that offer pretty competitive rates, not quite residential, but pretty close. And they will finance residential real estate underneath a small business. And the rates are somewhere in between residential and commercial. So you're not going all the way and paying the extreme of commercial lending rates. And in fact, some of the lenders are only 1/4 to 0.5% higher than their residential rates. And they can do a lot of cool stuff like lending in company names. They can use income from an active corp and use that to help supplement the income in order to qualify for it. So there's a lot of cool things that they can do that often only exist on the commercial side. So yeah, small business is a little untapped gem that we've been tapping into quite a bit over the last couple of years. Celine has a question. In terms of personal income for self-employed people, does the lender look at corporate income if our T4 is not high enough? So good question, Selena. There are a couple of programs called corporate net income. Some lenders will use between 40 to 60% of the corporate net income that the company made. So let me give you an example. If your company made $300,000 after it paid you your salary, so you took home $100,000 T4 income and the company made $300,000, and that $300,000 stayed inside the company. If you have a history of it and you've made that for the last 2 years or so, we have some lenders that can actually use a percentage of that $300,000 as if you took it home, as long as you are the only owner of that company, and again, only using a certain percentage of it. So there was a time, especially during COVID, where a lot of lenders tapped the brakes on that, and it was more difficult to do. Since then, some lenders have brought these corporate net income programs back to the table. Sometimes they restrict the financing amount, so 65% financing max instead of 80%. Some of them only do it for owner-occupied properties. But we do have a couple of lenders who can do up to 80% financing. We can use corporate net income as if it was take-home income to help you qualify. Some lenders use all of it. Some lenders have their own little calculation where they take some things and add or subtract items on and off, like amortization and a few other items. And some lenders just use 40 to 60% of it. So if you wanted to understand if you roughly would qualify in an easy way, then you take 40 or 60% of that corporate net income, add it to your income, and that could be a waiver you could qualify. Lena has a question. Hi, we have a fully paid off residence with a HELOC. We have 5 rental properties, 2 corporate and 3 personal, and I haven't gotten a no from a mortgage broker, but I also haven't asked yet. I think I'm probably not going to be able to get more mortgages based on our not so high household income. On the fence between going for something small family with JV partners or pursuing 5+ units or both. I guess this kind of depends on how big you want to grow it. If you, and it's hard for me to tell in a high level what your options might look like. I will say that we did design an internal tool that we use, and it's a very quick analysis tool, because I'm sure it's frustrating, Lena, to have to send over 200 pages of documents to a mortgage broker, and then they say, yeah, you know what? I'm sorry, you don't qualify. It's a waste of time for everybody. We have a spreadsheet that if you email us, we can send you the spreadsheet. You can fill in your portfolio, all of the numbers and your income, and then we actually put it in and input it into our master spreadsheet, and it'll underwrite it for us. And we'll be able to say, Lena, you qualify with these 6 lenders, or you know what, it's really going to be tough. Maybe you should focus more on the commercial side. So we can help you with that decision making. One of the benefits of residential, if you can qualify for it, is the leverage is often higher and the mortgage rates are lower. So that's one benefit to doing it. On the flip side, though, if you can't get into residential, it doesn't mean that you should stop. It means that maybe you should just sit back and start to think, okay, well, maybe I should get into multifamily. We actually see that a lot of people get into joint ventures on the multifamily side. And I've been doing a couple of myself. I've been doing a 14-unit apartment building flip in North Vancouver. And that one where we've sold so far 10 out of the 14 units. So we're wrapping that one up shortly, and there's a very profitable return for ourselves and the investors in that one. And we're working on another one in Victoria that's a Airbnb deal that we're currently trying to wrap up the investors on that one too. So I find that when you get into the bigger deal sizes, a lot of the time you need to start looking at joint ventures because you need more capital, and it's a little bit harder to play in that sandbox. So that might be something for you to start to consider. And if you haven't joined any investment groups, then that might be another way to do that, especially if you want to start getting into commercial lending. But again, if you want a bit more of an analysis on that, I would say just to send us an email and we can help you with that. Rose has a question. I am incorporated. My partner wants to borrow 30 grand. How would you structure that, personal or business, or not at all? I want to purchase first home and wondering if this would be a smart move. Okay, so you're incorporated and your partner wants to borrow 30 grand. How would you structure that? So just to clarify, I'm not sure if your partner is borrowing 30 grand from you or what the situation is. But if you're incorporated, it's generally difficult for you to qualify for mortgage debt. And so one of the challenges is that it is difficult for lenders to recognize any loan agreements you may have, even if it's generating income, unless it shows up in your tax returns. So I don't know if you're trying to borrow, if your partner's going to borrow 30 grand and then have some debt, and now it's going to be more difficult for you guys to go out and buy your own personal residence. That might be something you guys are looking at doing. But high level, if you just look at the fundamentals here, Rose, if you're incorporated, you're probably showing a low income on paper. And if you're trying to look at borrowing money before you guys go buy your first home, my advice generally is, if you're going to borrow money for whatever reason, try to go qualify for the mortgage first, because the 30 grand debt is a lot easier to qualify for than the $300,000 debt or the $600,000 debt. Way higher stakes and much more difficult to qualify for. I remember when I bought my first property, I put 0 down. I got a 40-year amortization. This is back in 2007. And I was 19 years old, and I bought a property for $300,000 with no money down. I maxed out my debt servicing, absolute maximum. And then I went out, and 2 weeks later or 4 weeks later, I went out and got a brand new car. Yes, smart mortgage broker. I regret getting a new car. Of course, it was 2007. Everything's hot. Everything, great market. But I bought a brand new car, and the car payment was nearly $500 a month. And so even though I maxed out my borrowing power on the mortgage side, I was still able to go out and qualify for another $500 a month in car payments. So in general, get the mortgage first, get the other debt later on. So I'll swing over to the chat to see if there's any questions in here as well. Let's see here. Okay. That's good. That's good. Harjeet has a question. Can you give an example what an operating company would invoice the holding company to transfer the income earned in the holdco to the lower tax bracket, other than interest charges for lending to the holding company? Okay, so good question, Harjeet. An example would be the operating company invoicing the holding company to move the money from the higher tax bracket of the holdco to the lower tax bracket of the operating company. It would be property management and consulting services. So if you call this property or this entity a property management corporation, then you're invoicing the holding company for services provided and rendered. Again, that's where it gets a little bit tricky, a little bit hairy. And one of the things to look at would be, well, does this company provide services to any other individuals, or is it just providing services to your own real estate holdings that you own? That's something that you'd want to take a look at for sure. So just something to keep in mind, and always talk to an accountant before you set up any of this, because I've had a lot of accountants say it's very difficult or challenging to set up, and so there's a lot of things that you'd have to look at whether you tick the boxes or not. All right, let's see. Is there any other questions here? Todd, it's not too smoky anymore in the Okanagan now. It was when we first got here, but yeah, not so much. And Wendell, yeah, good point, Wendell. So much for the 1% rule. Yeah, I know Ozzy Jurok used to mention that a lot. Go out and buy real estate where the rental income is 1% of the property price. Yeah, that doesn't happen anymore. That's for sure. So that's something to keep in mind. Let's see here. Any other questions? Oh, here's another question. So Philip is asking, please repeat why to buy in a holding company that pays higher taxes. Number one, Phil, is that most lenders will not allow you to purchase in an operating company. Most require you to purchase in a holding company. Number two is talk to your accountant, because my understanding is the CRA does not like it, or they will not allow it, depending on the situation. So that's something else to look at. If it's just a regular rental property, then I think that the CRA would view that as non-active income. So that's the other reason. A third reason is liability reasons. So if you have an active company that is conducting business, and then you get sued, if you own real estate and other assets in the company, well, now the people that are suing you have more stuff to go after. So it's usually good to separate it. So anywhere you're exposing yourself, your business could get sued. Usually don't want to have any assets held inside that company. When was the question? What is the difference between having the active companies side by side as opposed to the version where you have the holding company own? Same reason as I just explained, actually, with regards to why in general your real estate holdings should be in a holding company and not an active operating company. Okay. Okay, got it. William, I see your question. I'll send you a note as well on that one. And Wendell, the operating company, is speaking about your diagram. So yeah, it's so having the active companies side by side as opposed to the version where you have the holding company own the rental properties. I think the difference, Wendell, is that in general, an active company is not generally holding real estate for a number of different reasons, and that's for the liability reasons. The fact that I don't think the CRA likes to allow it, and frankly, the other thing too, even though the holding company is taxed a higher tax rate on the income, keep in mind that in general, when you're buying rental properties and you're getting the maximum leverage possible, you're actually not usually putting a lot of income through your holding company. Maybe later on you might see that you have a lot of income, but usually not later. So, or not until later. So that's something else to keep in mind too, is that yes, you might be generating some income, but probably not a lot. Awesome. Any other questions, guys? It was good to see a lot of familiar faces at this presentation. Thanks so much for coming out. The next one is on September 1st, and so I'm looking forward to seeing many of you at that presentation as well. And thanks very much for coming out, and have a good day. And yes, this will be the most casual you guys are ever going to see me in my vacation outfit. All right, thanks a lot, guys. Have a good one. Bye now.